This is Nightly Business Report with Tyler Matheson and Sue Herrera. More than 10,000 people retire every day. Tens of millions already there, and generations to come. But things are changing.
I think retirement is almost like a wishful thinking thing these days.
Saving for retirement is becoming more of a challenge. From shrinking options,
I have a pension, but I don't know if it's going to be there in a few years from now,
to rising health costs, Americans' increasing struggle to put away money for their golden years.
If I were to retire right now, I would be a homeless person.
Tonight, Nightly Business Report examines America's retirement crisis and options for funding your future.
And it is one of the biggest financial challenges of our time, saving for retirement.
And tonight we are hoping to shed some light on this issue, which certainly affects millions of Americans.
So we welcome you to this special edition of Nightly Business Report. I'm Sue Herrera.
And I'm Bill Griffith in tonight for Tyler Matheson.
Well, the numbers, they're pretty staggering. The vast majority of Americans have under $1,000 in savings. And by some estimates, half of all Americans have nothing put away at all for retirement. And this runs across pretty much all ages. Sharon Epperson delves into the problem.
About 10 years ago, Galen Murphy realized he'd never saved for retirement. Now he's 49, and he's still not saving.
Not right now, I'm not. I was hoping to in this next year. I like this.
Murphy earns about $42,000 a year working as a store manager at Portland's House of Vintage.
Fredericks of Hollywood.
The company has 2 stores, 5 full-time employees, and no retirement plan. Murphy says he makes enough to pay his bills, barely.
The biggest ones are going to be rent, student loans, health care, car payment.
Living the American dream? For too many people, it's more like a nightmare. And Galen Murphy is hardly alone. He plans to keep working as long as he can, but still wonders which bills will get paid and which ones won't. There's no money left for savings. Only about 40% of the private workforce has access to an employer-sponsored retirement plan. And even those who are saving still aren't saving enough. One problem? Pensions became a thing of the past. In 1983, almost 90% of the workforce had pensions. By 2016, that number had dropped to 27%. Today, 94 million Americans have retirement accounts. Yet a recent Vanguard study says the median 401k for someone aged 35 to 44 held less than $24,000 in 2016. For a 45 to 54-year-old, $43,000. And for someone 65 and older, the median balance was less than $61,000. How big a problem is this?
I think it's much bigger than one can imagine.
Ivory Johnson is a Washington, D.C.-based financial advisor.
The ones who have not planned are, I think, the majority. If you look at the number of retirement accounts that have less than $50,000 as a percentage of people over 50, it is staggering.
Johnson says putting a higher priority on saving for retirement needs to start at home and continue in school, but that's not happening.
Look at social media and Facebook. What are people posting? They're posting, I went on vacation. This is where I went to eat. This is where I sent my child to college. What's celebrated is not I have a plan and I'm setting myself up for retirement.
Student debt is one of the culprits. Galen Murphy, at 49, is paying about $365 a month on $62,000 of debt that's accrued since he was in graduate school more than 10 years ago.
That, for me, is the biggest issue.
Tim Ranzetta's Next Gen Finance studied 13 million students across 11,000 high schools, finding less than 17% are required to take a personal finance course to graduate. So, he says, how could they be expected to understand how tens of thousands of dollars of debt might impact their lives?
We believe all students need this sort of education in order to thrive in the future.
Now approaching 50, Galen Murphy knows he'd have to give up a lot in order to improve his quality of life in the future. It's a cost that only seems to keep going up. For Nightly Business Report, I'm Sharon Epperson.
So what are some possible solutions to our lack of savings? Our Steve Leisman did some digging for us.
People don't always do the right thing with their money. In fact, sometimes they're downright dumb. That was a major finding of University of Chicago professor Richard Thaler's work that helped him win the Nobel Prize in Economics this year and, among other things, has had a profound effect on America's retirement savings.
Economics is based on the assumption that everybody is super rational, has no self-control problems, never has a hangover, saves exactly the right amount for retirement and then invests it perfectly. The rest of the world is nothing like that. We're more like Homer Simpson than we are like Spock from Star Trek.
Instead of giving people the choice to enroll in retirement savings plans, Thaler's idea was to enroll them automatically. They would have to opt out if they didn't want to save. This helped increase the number of Americans using defined contribution plans like 401ks and Roth IRAs. More Americans also decided to automatically increase those savings as their salaries rise.
You say to people, look, you're only saving 3% now. Would you agree to increase it 2% a year until you get up to some reasonable level? That works wonders.
But the growth spurt since Thaler introduced behavioral economics to savings has stalled, and the actual dollar amounts of savings remain low. A third of all Americans, for example, have no savings at all. Policymakers struggle with how to prompt low-income Americans to save more and how to adapt to an economy where more workers are self-employed and earn irregular income from the gig economy. For them, savings is always voluntary and difficult to plan. Senator Jeff Flake and Congressman David Brat introduced a bill to create universal savings accounts, a supercharged Roth IRA with no penalty for early withdrawals. Those penalties are a reason many low-income Americans don't use them at all.
Both Canada and United Kingdom enacted accounts that are universal savings accounts within the last decade or so, and they've proved to be hugely popular, with about half of the public in both countries using them.
Even while both lawmakers are Republicans, the provision was excluded from the latest tax bill. And that backs up Thaler's original idea. People, be they lawmakers or regular Americans, don't always do the right thing when it comes to money. Sometimes easy fixes like saving more or enacting the right savings plan in Congress elude us. For Nightly Business Report, I'm Steve Leisman.
So let's bring in our first expert. Jack Vanderhei is Research Director at the Employee Benefit Research Institute. Welcome. Nice to have you here, Jack.
Thank you. It's a pleasure.
You say that this is a dire situation for certainly people who have not saved enough, but there are some parameters that you've identified for us. Tell us about those.
Well, we've been studying national retirement income adequacy now for many years. We built a model in 2003, and every year we rerun it to see basically for those people who have not yet retired, what percentage of them will have sufficient retirement income. The number is perhaps strikingly low in many cases. It's overall about 57%. But the thing that you have to keep in mind is that we're really telling a tale of two different populations. We have those people who are fortunate enough to work for employers who have employer-sponsored retirement plans, and unfortunately those that don't. The probability of having adequate retirement income is over 50% higher for those people who are working for employers who have those particular types of retirement plans.
I have to say, I learned something. Social Security, if you wait until you're 70 to begin drawing, rather than waiting when you're at first eligible, your benefits go up by 76%. And the trick is waiting that long, right?
Right, and what obviously is happening there is you're taking the same types of benefits that you've accrued through Social Security and having them paid out to you during a smaller period of time, so that 8% increase for each year of deferral is going to amount to a significant increase overall in those benefits. If possible, it's always nice to delay those claiming of these retirement benefits, especially if you're continuing to work, because if you start taking those benefits before what's called your full retirement age, for somebody in my age group that would be age 66, then basically if you're continuing to earn more than a particular amount of money, you in essence sacrifice $1 for every $2 you earn. So it's very important to not claim too early.
Let's bring in another expert here. Jack, stay right there. Joining us right now is John Leitner. He is director at the University of Michigan's Retirement Research Center. And actually, John, you don't think we're in a crisis yet. Why?
Well, I should say I'm glad to be here.
Welcome.
Thank you. The I would say in the aggregate numbers I deal with, and I tend to look at older people, maybe in the 50-plus age group, that while things are far from perfect, I don't perceive us to be in a crisis yet. And I hope one can be avoided. And I say that, crisis yet, because the basic retirement instrument for most people is Social Security. Now, Social Security right now has a trust fund of about $3 trillion, but the predictions are that in 16 years, that trust fund will be depleted and benefits would be cut substantially. So when I'm optimistic, I'm optimistic that we have some time to correct that and bring the Social Security system back into full solvency.
Okay.
Jack, let me turn to you, though. One of the factors that you think most people, whether they have a defined pension plan from a past employer or a 401k or whatever it is, many of them are not factoring in how long they will live and long-term care costs, which can be catastrophic if you don't factor that into your planning.
Well, absolutely. And unfortunately, many people just look at some kind of target replacement rate that if they think they can have 70 to 80% of what they had pre-retirement, they're going to be fine. The problem is, of course, that's using averages. And if you end up living longer than the average life expectancy, perhaps 17 years for male, 20 years for female at age 65, or even more importantly, you have catastrophic long-term care expenses. A 1 or 2 or 3 year stay in a nursing home or assisted living facility easily can take the finances which otherwise would have been sufficient to get you through retirement and deplete those very, very rapidly.
John, since you're not worried yet about Social Security, when do we start worrying, and will there be enough? What about the Gen Xers who are likely not to have something waiting for them when they get to be retirement age?
As I say, the predictions are that the crunch hits Social Security in 16 years, 2034. So there is time yet to put in a fix. Now, we had some experience with that in the 1980s. We made some adjustments, and things have lasted until now. So I'm very hopeful that there'll be a bipartisan commission or whatever to make some adjustments again.
All right.
But we do have some time to do that.
All right. I certainly hope so. Jack Vander Hei with the Employee Benefit Research Institute, John Leitner with the University of Michigan's Retirement Research Center. Thank you both for joining us tonight.
Thank you.
Thank you.
Still ahead, your questions on retirement answered by noted financial expert Gene Chatzky.
Have you been saving money for your retirement?
I have. Probably not nearly as much as I should. My husband and I always hope that maybe we'll win the lotto.
I definitely could be saving more. I'd probably say opening up another savings account and just every paycheck transferring over, a certain amount every 2 weeks or so. But yeah, like I said, at the moment I think my priorities, I guess, aren't there, and I'm not thinking that ahead into the game, but I could definitely do a better job, yeah.
An unexpected event like an accident or illness can become a financial disaster if you're not prepared. If this happens, the last thing you want to do is tap your retirement accounts to pay for medical bills. Protect your retirement savings from unexpected expenses by planning ahead and taking these 3 important steps. Get disability insurance. You insure your car and your house, so why not your income? This kind of insurance will provide steady payments if you become unable to work. Most disability policies that you get through your employer usually cover 40 to 60% of your salary. Bulk up your emergency savings. Put away enough money to cover at least 6 months' worth of living expenses in a rainy day fund. Start small, build it up 1 month at a time, stashing away 1% of your pay, then 5%, then 10% until you reach your goal. Create an estate plan. These legal documents determine who will make key financial and health care decisions on your behalf. You need a health care power of attorney to handle your emergency and ongoing medical care. Also designate create a durable power of attorney to make financial decisions, including making sure your bills are paid. If you have no other option than to take money from your retirement accounts to pay for medical expenses, watch out for tax penalties. Normally, you'll be hit with a 10% tax on the money you withdraw before reaching age 59 and a half. However, there are a few medical exceptions that apply. Go to irs.gov for details. But that's the last resort. Take the other steps first so that you don't have to drain your retirement savings and you can retire well.
All right, we do welcome Jean Chatzky, of course, the famed financial expert, the host of her Money podcast. And first of all, welcome.
Thank you.
We're glad you're
Great
here.
to
We're going to
see
get to
you.
a lot of questions from our
It's nice to
viewers
see you too.
on
Thank
all of
you.
this. But what about the issue now that we have to worry about in retirement of medical expenses? I mean, that's a crisis as well,
It
right?
is, because of the issues that you were talking about in the earlier pieces. As Sharon noted, we've got rising longevity. And that means that people have to plan for these very late in life healthcare expenditures. If you look at where people's money goes, we know that people are spending the most when they're about my age, when you've got kids in college. But from there, it tails off a little bit during the early years of retirement, and then it's in those last years where those healthcare costs kick in, and we need to think about things like insurance, whether it's long-term care insurance or longevity insurance, in order to protect ourselves.
And nobody wants to think about being sick. That's
No.
the other issue. There's a lot of denial. I mean, understandably so, but no one wants to think that you're going to be the one that needs that long-term care insurance.
Or the will, or the power of attorney.
Right.
And the statistic that gets me always is the one that says that half of adults in this country don't even have a simple will. And there are a lot of parents in that number, which I just think is unconscionable.
When should you be thinking about long-term care insurance? I mean, it's cheaper the younger you are and the healthier you are, right?
But if you buy it too young, then you're going to end up paying the premiums for too many years. So the sweet spot to buy it is around 50, 55 years old. It's not right for everybody. It's very expensive. And if you can't afford to maintain the premiums, it's just money down the drain. So if you've got assets of between $1 million and $4 million in liquid assets, not including your house, that's where it makes the most sense, because for people who've got more money than that, they can often self-insure. For people who have less, they'll often spend through their money and qualify for Medicaid.
Good advice. All right, well, we've got some questions because we asked for the questions. You mailed them into us, emailed us. It was terrific. Thank you. Here's basically one question that we got a lot of. Our first question comes from Victor, and here's what he emailed in. Please use a typical scenario of retiring at 65 with about $100,000 saved in a 401k, annual income of $80,000, but no pension, includes Social Security, current age of 50, saving about 10% per year in that 401k. He's assuming that the house will be paid for, and the calculation is for a couple. The calculators out there assume too much of a pre-tax income to be maintained. He's saying that basically everything, all those financial tools are assuming too much. Do you agree with that? And what do you make of his question?
Well, I agree to some extent. I mean, we are seeing retirees, when we look at their real spending during these years, as being pretty resilient and pretty able to go with the flow. So if they have years where their money in the markets is down a bit, they're just spending less. They're taking one less vacation. If they have years where their portfolios are doing especially well, they're taking a little bit more out. They're spending a little bit more. That scenario that he laid out, and if I could ask the control room to go to the second graphic that I sent you, that would be really, really helpful, takes a look at how much money Social Security is actually going to replace for you. And so what we see here is that for somebody who earns about $100,000, Social Security is only going to replace 27% of their money. The other portion to make up that 72%, and what we're not doing here, the reason that those replacement rates in the last column are so much lower is because we don't have to replace the money that we're saving. That's already done. Right. So if we can go to the first graph, you'll see that in order to meet these numbers, we actually have to come up with substantially more money than people are saving now. By age 30, you want to have 1 times your income put away, by 40, 3 times, by 56 times, by 68 times, and by the time you retire, 10 times. These stats are I pulled from Fidelity Investments, but Aon Hewitt has similar benchmarks. And the problem is that people aren't getting close. And that means that wherever you are now, you got to downshift in order to make at least some more savings possible.
Okay, I'm optimistic now. But these are the hard numbers we need to hear, right?
They are. I was telling Sue before, I put these numbers on Twitter last week. People went nuts. I mean, I got thousands of comments along the lines of ha, 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 ha. Because if you haven't been doing it, it's daunting. But if you can start, and Richard Thaler was very, very known for his nudge concept. You nudge yourself up. Start saving 2% and then just do a little bit more every 6 months.
All right, we have some other questions here. We actually went out to the street and asked people for your questions. Here's one of them right now.
What would be the most effective way to save money without breaking the bank, basically? To be able to, you know, buy food, pay rent. Yeah, how do you save with a very limited budget?
It's what my wife and I used to call poverty mode back in the day.
Exactly.
Right?
And there are some do-it-yourself ways. You can automate a contribution of $25. Just move the money from your checking account into your savings account. Every time your paycheck lands, you put it on automatic pilot, you try to forget about it, and you just let it ride.
And then deal with it in your budget.
Yeah, but there's also an app that I love called Digit, and it does this for you. You give it access to what's happening in your accounts, but it has a crafty algorithm where it figures out how much you can afford to save, and then it moves the money for you. And I know millennials in New York who are earning in the $40,000 range who are saving thousands of dollars a year this way. Now, they charge $2.99 a month for this. So I just want to be clear, there is a small fee, but if you're going to save thousands, I'll pay the $2.99.
You know, you brought up millennials living in New York. That's another factor, is it not? Where you are going to live in retirement.
Yeah.
It is really expensive on the West Coast and on the East Coast. But there are other parts of the country that you should really consider.
Yeah, interestingly, AgeWave did a batch of research with Merrill Lynch just in the past 6 months, looking at people who are entering retirement. And among the ways they found people stretching their dollars was just saying, hey, I own this very expensive house that I don't need to live in anymore. I'm going to sell it. I'm going to go to Peoria or someplace else. Buy something comfortable, affordable, and then take that actual equity and live off it.
We got to go, but the best advice is do the best you can.
Absolutely.
Right?
A little bit. Just start with a little.
And don't get overwhelmed.
No.
Because that's what we're here for. Thanks, Jean.
Jean Chatzky, as always. Great to see you, and thanks for that important advice.
We're going to continue. Jean was a terrific guest. And thank you to everybody who sent in the questions. Right? Coming up, Bill?
That's right. Why the new retirement is not retiring.
Do you think that you could be saving more money? And if so, how would you save more money?
I don't think so. Too much things that you have to pay. The amount of money that you can save, it's not that much.
They don't supply 401k like they used to, or even if you contribute to your own 401k, they don't match like they used to, so it's kind of like difficult to try and save, especially if you have kids and they have to go off to college and everything's getting more expensive. So yeah, I kind of worry about that sometimes.
She's not alone. A growing number of Americans are not retiring in the traditional sense anyway. No golf, no lounging by the pool. As Jane Wells reports, the new retirement is not retiring.
I may bring in the camera close right here.
Veteran Assistant Director Jason Roberts is giving a class to aspiring background actors at Burbank's legendary Central Casting. One of his students is 67-year-old Abe Rogland.
It's fascinating being on set.
Rogland used to own a logistics company, but that went south in the recession. Now he's pursuing his love of acting full-time, partly because he needs the money, and says he's not the only one on the set who does.
A lot of them have cashed out the IRAs already. A lot of them are working now because they have to pay the rent. Social Security is just not making it.
The Employment Benefit Research Institute found that 42% of people working for pay after retirement need the money to get by. But at the same time, almost all of them also do it for fun.
I get bored.
77-year-old Walt Krakowicki retired at age 60 from a career in food services management at Universal Studios. Now he picks up odd jobs as a background actor, not for money, but to keep busy. He even did a scene with Cameron Diaz for Bad Teacher where she washed his Cadillac.
Yeah, she washed my car. I didn't wash my car for about 2 months after that.
The fact is, we're living longer, healthier, and more active lives. That's why the Mizell Senior Center here in Palm Springs is a hive of activity. The EBRI survey says at least half of Americans expect to live to at least age 85, and more of us are retiring earlier than expected, but we're not sitting around. People like Sherry Goodlow.
I had breast cancer 6 years ago, and I looked at between 62 and 65, and I thought, do I really want to stay there another few years, or do I want to start really living?
Goodlow ran the numbers, realized that with a little downsizing, she had enough retirement to, quote, start living. Now, through a website called Trusted House Sitters, she house sits and pet sits around the world for free.
I plan to do this as long as I can. I love it.
Retiring is a lot less retiring than it used to be. For Nightly Business Report, Jane Wells, Palm Springs.
And we thank you so much for watching our special edition of Nightly Business Report. I'm Sue Herrera.
I'm Bill Griffith. Have hope. Have a great evening as well. We'll see you tomorrow.